So one fund lost the passphrase to a $1.5 million Bitcoin wallet and offered me 20% if I could break into it. That was the introduction to the business.
This podcast is for informational and entertainment purposes only and is not investment, legal, or financial advice. Opinions are those of the host and guests and do not reflect any affiliated entities. Investing involves risk, and past performance is not indicative of future results. The host and guests may hold positions in discussed securities. Now, please enjoy the show. Diogo, thank you so much for joining me today. Super excited to chat with you. All right, so you are a general partner at Haun Ventures. You are a co-founder and executive chairman at Anchorage Digital and a chairman at the Near Foundation. So Haun Ventures is a $1.5 billion multi-stage venture capital firm. You guys back founders from the earliest seed rounds to the latest growth stages. Previously, you were a security lead at Docker and an early employee at Square, where you also were involved with security. All right, so Diogo, you have a PhD in computer science, and I just have to imagine, like you as a kid, were you just hacking away at different things and building different things, or how did that love for kind of tinkering and building, did that start when you were younger, or was that a kind of like a college age thing?
So my dad taught me how to program when I was 12 years old. And from that moment on, the first thing that I started doing with my programming capabilities was building malware. It was the first thing that came to mind. And, it came from a place of not particularly popular in middle school and high school. And one of the things that is unique about me was I had this dad. I was really good at technology. They taught me how to program. So I was way ahead of the curve in terms of technology. And I think it's a story as old as time, back in the 90s, in the 2000s, where I had this really cool thing. I was part of the IRC channels. I knew a lot about computers. I could make them do cool things. So I started building like small malware that would open the drive, would kind of like propagate itself, would like not allow you to click things, would like close windows, would like, ghosts on computers would be the general description for like the thing that I was doing. And that got me interested in more programming, which got me interested in more security. So security really has been the one conducting force in sequence across all of my career, from 12 years old to today. And we can like do the hops one by one. But it was that led me to doing a bachelor's, a master's, and then a PhD in computer science and security, which is the topic of security. So I was published academic papers, on proof of work, which at the time I called computational resource tests, and Sybil detection and protection and distributed systems, and working on this area, which now we call it blockchain. And so 15 years ago was useless, just an academic pursuit. But I was lucky enough to have the academic portion. And then that's what leads me into Square, directly working in security. I actually am on the patent for the little encrypted credit card reader I'm sure you swapped your card on at some point. So your credit card is on file. Then that leads me to Docker, super fast growing container technology, runs on every single cloud on the planet. Securing the infrastructure and the substrate that everybody's using was pretty crazy challenge. And that leads us to starting Anchorage with Nathan in 2017, two security engineers building what it is, the world's most regulated and safest one password, right? Because ultimately is private key generation and safekeeping wrapped as a bank. And so that's really what it is. And then finally, as an investor into blockchain, all of it has one conducting thread, which is security and distributed systems. As a researcher, as an operator, as a founder, and now as a capital allocator.
That's amazing. Wow. Okay. So take me back to when you were tinkering on that malware, and like it's a fun, mischievous thing to do. What did you enjoy about that process? And like, you're a teenager at 12, 13. It's kind of a fun, rebellious thing to do. Was that kind of the driving force, or was there like, I can make money from this, or what was?
No, it wasn't. The entrepreneurial bug came a little bit later. I think, the most frank way that I can say, well, first, let me disclaimer, there were no computer crime laws in Portugal at the time. And so all of this was safe. But it was really just, I knew something that people didn't, and I could do stuff that other people couldn't. So it's like, how do you look cool to your friends? A lot of people are great at soccer in Portugal. A lot of people are extremely popular, and I was the computer nerd, I guess. And so the way to be popular and belong and have a group of friends was to show my skills. And I had a lot of fun doing it. And so I was lucky enough to find very early on the thing that I wanted to do and to be good at. And I've never veered from that path. So it's pretty interesting. Obviously it morphs, but it morphs from like, you want to show yourself to your friends, and I can contribute to this group and to this community, and I'm a valuable member of this community. I want to be accepted. I want to have friends. That's the drive behind it. And the way to do it is show how cool you are about doing all these internet things at the time. 12-year-olds and 13-year-olds simply couldn't build their own websites. They didn't know anything about IRC. They didn't know how to like write computer programs. And so all of that was an edge that I had, and a way to make friends ultimately.
That's awesome. Okay. So, I'm hearing social. I'm hearing, computer networking and security and just CS broadly. So like at what point did you discover Bitcoin? Because there's a lot of like, elements of that in the story of Bitcoin. So is that at an early stage or?
I mean, it's so interesting, the fact that I quote on my master thesis and PhD thesis over 60% of the same papers that that Bitcoin quotes, because it's Dusur, it's like Hashcash. It's like, well, I was working on the same things, except at the time of my PhD, I called them computational resource tests, not proof of work. And so that's what I called it, right? And I was working on Sybil detection. So one of the problems that Bitcoin solved was obviously Sybils in the general description of like Sybil identities, and one ability of having global ordering and have protection against double spend and having just a consistent ledger that is consistent across everyone. He did this in a very interesting way. I had done this in my master thesis and my PhD. So when I saw the Bitcoin white paper, which is when I was early at Square, around the time that I joined, 2011-ish, I had read all of the references. I knew exactly what was happening. And I loved it, and I tinkered with it, and I bought some just to tinker with it, but I did not see the monetary policy aspects of it. I had grown up in Portugal. I hadn't really felt the 2008 crisis. A lot of those aspects of the anti-bank narrative and the money printing, and they just like went way over my head. I wasn't really thinking about monetary policy. I was an early engineer at Square at a very fast growing startup, and I was doing super cool things and having the time of my life. So it didn't really capture my imagination from that perspective. It captured my security nerd imagination, my PhD, distributed systems imagination, but not really the monetary policy and this has value. This is digital gold. I'd never been a gold bug. I'd not studied it, and I'd not read anything about it. So it was much later in 2013, and then really in 2015 to 2017, while I was at Docker, that firmed up for me in terms of an investment and in terms of crypto as an investable category, et cetera. And then it was in 2017 that it crystallized with funds reaching out to me for help with consulting with security. And then the idea for Anchorage kind of like crystallizing, and Nathan and I starting this company together. So at that point, it was already full on. I knew what was happening. I understood all of the elements around Bitcoin, and I had read and invested a lot more into it.
Amazing. Okay, so what switched for you, or like what changed to view Bitcoin less so as a really cool technology, more so as a monetary, or like an asset? Like you said, it was around the 2015 era. Was there something specific that you saw where like, oh, this actually makes a lot of sense with the money printing and whatever digital gold narrative, or whatever the narrative was at that time? What was that switch from technology to more of an asset?
I don't know if I have a good answer for you outside of the mainstreaming of Bitcoin that happened, and the booms and busts and the people getting rich and people talking more about it. And then the more people talk about it, the more you kind of like dig. You see it over and over again, the monetary aspects of it versus like the technology aspects of it. And you start seeing the religious nature of it, the fervor, the religious fervor, this jihad, right? This religious war, the block size wars, all these things. You start seeing those things and you're like, wait a minute, there's a lot more here than what I thought there would be. Why would people behave in this way? And then you understand the social coordination aspects and the monetary coordination aspects. And the monetary coordination aspects come from the 21 sacred number, 21 million sacred number. It's not really 21 million, is, it's asymptotic, but it's almost 21. And that kind of like brings you to why are people behaving this way? Why do people care so much about this? And then you start like digging. And then you understand the rest of the monetary policy. This was at the same time that I was finally making some money, right? I was coming in, first job, making some money. Before 2011, I really didn't have money to invest. And then in 2015, I started having money to invest. And later, after Square IPO, I had a lot of money to invest. I was lucky enough to have a lot of money to invest. So when you have money to invest, you have to learn about investing. And so you read more and more and more. And by reading more and more, you start understanding the impact of interest rates and the impact of money printing. And you start becoming curious and reading about historical monetary policy and Richard Woods and the euro dollar and all of these things that just like come up everywhere that is just like, I don't know anything about this. And so you have to consume it and read it, and central banking and why it come to be, and what happened, and FDIC insurance and how banks work, and, in investments in stocks and bonds and allocations and portfolios and in volatility and, alpha and beta. And so that's when you become interested. And then Bitcoin sort of makes sense as, because you understand all of the claims that people are doing may not be true, but all the claims that people are doing around it, you understand all of the aspects of what's available and what is actually positioning itself as a counter to, which up until that point, it was just technology.
And so folks were, or specifically crypto investors were reaching out to you because of your security background, asking what's the best way to custody this stuff, or how did that?
So one fund lost a passphrase to a $1.5 million Bitcoin wallet and offered me 20% if I could break into it. That was the introduction to the business. And so that was the first time that I realized very sophisticated investors were not very sophisticated at operational security. And that was a market. And so I started consulting and doing all of these things until, Nathan and I realized, wait a minute, this is a business. This is not like a consulting business. This is a platform business. This could be huge. As crypto grows, more institutions are going to come. It's the only way for crypto to be successful is for TradFi to adopt it and really like allow it to expand and get distributed. And we're going to need custodians. Institutions are not going to do self-custody. In many cases, they couldn't. Legally, they couldn't. RIAs have to use third-party qualified custodians. So all of this started crystallizing of like, no, this is much bigger. And this is perfect founder market fit. We had worked at Square. We had gone all the way from early stage company to publicly traded company. We had helped the company structure itself and become IPO ready with all the compliance aspects. We had built underlying infrastructure. Nathan and I had been working on private key management for 7 years at that point together every single day. We were just a perfect team. What better than two security tested engineers in the center of Silicon Valley to create a custodian for private keys that are worth tens of billions of dollars. And lo and behold, we have over $60 billion of assets on the platform today.
Wow, that's insane. Okay, so what do you, you kind of answered the question there, but because there's been many custodians that are focused on crypto throughout the years, and Anchorage was, from my third party standpoint, I was like, oh, it's one of many. This is early on, 17 kind of days, 18 to 19. And other players have kind of fallen off or kind of, become less relevant. Anchorage just kind of steadily grew and now is this behemoth. What is the primary thing that you would attribute to the success of Anchorage?
I think to a large extent, it's focus on what you're trying to do. What Anchorage is wanted to be has not changed or deviated over the past 8 years. We started out we want to serve institutions. And if we want to serve institutions, what institutions care about is first and foremost, security, like technical security. They don't want to lose their assets. It's not even their own money. It's their LP's money. They don't want to lose their assets. And on top of that, as a proxy to security, there's regulation. And in some cases, it's not just a proxy for competence, it's a necessity. And so we needed to build the most regulated vehicle and that wrapped the most safe technology. That was it. And still today, that's what Anchorage is. Then we only serve institutions. And whereas a lot of these players went to retail when retail was popular, and there were times where, they're making a lot of money, basically stealing from consumers, charging like 2% or 1.5%. And you can't do that with institutions. Institutions are very sophisticated. There's lots of competition. Everything has to be amazing. Your technology has to be amazing. Your customer service has to be amazing. Your sales has to be amazing. Your combination of set of service has to be amazing. They're not just going to come for custody. They're going to come for custody and staking and settlement and lending and all of these other services that you really have to offer. So that's how we've expanded with client demand and what our clients wanted, and not speculatively of like, oh, clients who want the future, something like that. So I think that the answer is focus. We focus on being the best partner for institutions, period. And we went to get the best charter for institutions. We're still the only federal chartered bank in the United States that does crypto it's been 4 years. It's crazy. We're still the only one. Federal chartered bank that does crypto for institutions. That's it. It's us. There's no one else. It's N of one. And we have the best tech. And as we talked about before we started recording, we have the best product. We have the best people. And so that just compounded on itself. It's great culture, great reputation, two security founders that care deeply about building amazing products. And the rest is history.
So, obviously, like, you were confident going into it with your skill set. You and Nathan, your guys' skill sets match perfectly. But and still, we're actually early in like where I think Anchorage is going to be, one day. Did you expect it to be like this successful? Because I know it's like when you're just starting, it's like, how can you even imagine like 60 billion assets under management? It's like wild to even think about when you're.
No, you never imagine like being close to $100 billion. That is just in the realm of insanity. Even $1 billion. I remember our first $1 million day. I remember our first $10 million day. I remember our first $100 million day. I remember our $1 billion. Like, hey, we have $1 billion on this thing. And then, getting closer and closer to $100 billion now. It's kind of insane. I mean, you want to believe in it to a large extent. Being a founder is an exercise in irrationality. It really is. And not in terms of risk in the way that people talk about it. I think founding a company is one of the least risky things you can do, because the value that you derive out of the starting of the company itself actually pays for itself multiples of the time that you put in. And in today's day and age, if you're good at hiring, you just need to be good at hiring, which is hard. But if you're good at hiring, you've actually assembled more value in the startup that even if your product failed as an acqui-hire, than you would have assembled as an individual IC contributor over the same period of time. So getting a great set of people together and selling it as an acqui-hire later will drive a lot more value than you having 3 years more of experience. And it shows the market that you have the competence, the reliability, the capabilities to kind of like do and really wear this. The trade-off is that you wake up as a founder and you get punched in the face. And it takes resiliency and it takes lots of things, but there's no risk. True risk, monetary risk, really, there really isn't. Founders pay themselves reasonable salaries. They have tons of upside on equity and an option call on something like Anchorage, a multi-billion-dollar business. And on the downside, they're just going to learn a lot, get tons of cred, street cred on society, and just be acquired for, if they acquired the talents for a much larger amount than they would have been able to do it on their own.
All right. So I want to, before jumping into Haun Ventures, I want to touch base on that. So, because founding a company is not for everyone, but you said it's kind of the most, in some sense, the most logical path forward if you really want kind of outsized outcomes and just like almost any outcome. But do you think that we should have 10x more entrepreneurs?
Yeah, 100%. I wish that we did. I think it's much better for society. And of course, there's like,
but do you think that there's that available populace is able to be an entrepreneur?
I don't know. But in an abstract world where we want more entrepreneurs, I would say yes. And of course, somebody has to work for somebody else. And companies are going to become smaller, especially with artificial intelligence and the leverage. I think the companies themselves are going to be like more circumspect and not going to vertical integrate as much. They're probably going to like be smaller and smaller total and like use each other as services. So the large company time is probably over, and companies are going to start being really good at the area that they're really good at, and then offloading everything else to other companies that are much smaller that do exactly what you want. But this said, I wish that we had more entrepreneur society. And I think the biggest thing that leads people that have the capability and the endurance necessary not to do it to a certain extent is risk, is this appetite of risk. I have kids. I'm in a bad phase of my life. I don't have the time. I mean, many of these things are true. Just from a monetary perspective, I think people have overestimated the risk and the potential downfall. Because I think the prior version of entrepreneur of 20 years ago or 30 years ago, where you were putting all of your life savings into this one company, and you could not get any venture capital and any external funding until you had $10 million of runway and product market fit for a seed round. That has just disappeared. You can use other people's money to get really good, candid shots on target, and people will fund you, and you can pay yourself. I'm not going to say they're going to make a lot of money. $120,000 in San Francisco is probably the limit of poverty line. But you can pay yourself like a minimum salary, like $120,000 in San Francisco, and lower if you're in other places that are cheaper, and not really necessarily dip into your savings that much, and like be at the same level, but having high upside. Like what you have built during those years will accrue more value to your next hop, whether it's an acqui-hire or an acquisition, or even just a dissolution, will accrue more value because you've crammed in those 3 years 30 years of an IC experience. And I will, as an acquirer or as a hiring person, respect your track record and capabilities. I will judge you a lot higher than everybody else that comes that doesn't have that experience. So I do think that those 3 years are just winning, even from a monetary perspective right now. Like technically, like they may actually just maintain the same level. At least it's not the same thing as 30 years ago, where you're clearly dipping into your savings and you're taking like capital risk of your own capital. So there's the time component where you do have to put in the time, and it's much harder to put in the time when you have small children, but lots of people do it.
You also added that if you're good at hiring, it's a great choice to make. How do you get good at hiring?
I think there's an element of being, there's two ways of doing it. I think there's the instinctive way for you to filter great human beings and great talent. And if you're very technical in an area, you can sort of like filter out bullshit from not bullshit. I think that's one way. You're a technical expert and you're an area of expertise, and you're really good at it. And then there's people that are just really good at process, and they set up great processes, and they hire fast and fire fast. And so they try out folks onto the companies, onto the roles, give them the chances and the tools to succeed. But if they're not succeeding, they actually like change things quickly. And I think the two failure modes are people not course correcting, and people not being able to actually have a top line funnel that is not adversarial. So people relying on external contractors to give them candidates and not finding some organic way they themselves kind of like go out to market and get a high quality candidate pool. So two failure modes are you don't get into the high quality candidate pools, you're just relying on people sending you resumes, which tons of adversarial selection there, or you're not good at firing. And so you dilute your culture, and by diluting your culture and the people that are interviewing other people, you're actually going to dilute the overall quality of the company over the long term. So those are the two biggest failure modes. And if you cover for those, I think everyone can actually become good at hiring.
Wow. Okay. So, in terms of setting up that process, hire fast, fire fast. What would that ideally look like in a perfect world? Would it be, you assign them one task and they have 1 month to you see how far they get in that one task in 1 month, or like, what is that? What is that?
So the tactics of how you do it can be varied. For example, you can even go earlier on the hiring process. You could have work from home assignments and things that actually just reduce risk. So there's many ways to skin a cat in this particular situation. But the main thing is you can't abandon people, and you have to be on top of them, and you have to be very clear with expectations, and you can't allow for excuses. You have to give people the tools that they need. Many times that's a mistake. You're going to judge them, but you didn't actually give them a fair shake. And you're going to set clear expectations and guidance. And many times you're not doing that because startup is controlled chaos. A startup generally is an exercise in controlled chaos. There's always chaos. It's just how controlled the chaos actually is. When it gets too out of control, companies fail. When it's too in control, you don't have the creativity and the velocity, and it's too slow. So you need the controlled chaos. It's a necessity for success, because one of the startup super strengths is the velocity in which you progress versus incumbents. And you need that controlled chaos because it allows you more degrees of freedom, and it allows you to actually choose. Again, when you hire amazing people, they grow really fast, and they take on more things, and they take more off of your plate. And so you allow these people to grow versus stacking them under layers and layers of management, where you'll never know who the rough diamonds in the rough are. So these are kind of like the advantages that startups actually categorically have. But that means that you have to give them very clear expectations. You have to be clear on not thrashing them, on moving goalposts, and then you have to give them the tools to succeed, which many people in many cases don't do.
Amazing. Okay. So I do want to touch base on your comment. You said AI will make companies smaller in the future, but we'll do that later. I want to go into how you became a GP at Haun Ventures, because that to me is very, very interesting.
So it's kind of interesting. If you think about my career as I have described, I have done the academic thing, the PhD in distributed systems. I have done the operator of very successful Silicon Valley darling companies in distributed systems. I've done the founder in distributed systems. I had never done the capital allocator. There's something just beautiful about seeing the market. When you love this, when you love looking at these systems, when you love looking at other people's companies, which I love other people's businesses, there's just something beautiful about the investor role where people come in and pitch you. Really smart people come in and pitch you their life's work and their mission, and they're spoon feeding you like really cool things and tidbits and markets and cool insights that they have. It's awesome. So I really wanted to do that. And in fact, one of the ways that I found out that I really liked this was by angel investing. I've been angel investing for the past 10 years, and I have over 150 angel investments. And I basically wanted to professionalize my mini golf, right? Because mini golf technically is the same exact mechanics as golf. It has a club, a ball, and a hole for you to put it in, but it's a very different sport. So I really wanted to play the sport in the big leagues versus continue to play mini golf. And so that's why, I promoted myself to executive chairman of Anchorage. I still get to spend a lot of time. Nathan is an amazing CEO. The company is doing extremely well. And at the same time, I get to focus a lot of my time in seeing other things. Because when you're a founder in the company, you have these blinders on and you're focused on the business. And I felt guilty every time I was writing a check and I was doing some more intensive due diligence, which for my angel checks, is very minimal. It's just, is the team a cool team that I like? And is the market like a good shot on target? That's it. That's the due diligence. And then here you go. There's an 100K check. That was what it was. That's very different from $1.5 billion AUM fund, 500 early stage, $1 billion acceleration. The due diligence is different. The types of players are different. The check sizes are different. And that anxiety that you get from that is what I wanted, because it's when you're uncomfortable that you do your best work and you learn the most. So that's what I want. I want it to be extremely uncomfortable and learn as much as I can in the final area that I hadn't worked in, which was capital allocator within distributed systems.
Very cool. Okay, so what is the overarching investment thesis for Haun? Because from the website and just from the activity that I know, you guys can it's whatever. It's whatever makes sense. But is there like an overarching thesis for Haun?
No overarching thesis. We follow our curiosity and we follow what our market needs. And in crypto, it's very hard to have a thesis that doesn't change every 2 years anyway. And by the way, 2 years is actually smaller than the life cycle of the deployment of the fund. So you can't even be consistent about telling your LPs the story that honestly, 18 months later will be different, because the most luck that you have is you got the conviction of the story on the 2-year mark. Then 2 years later, before the end of the fund is already changed. But the reality is that on average, you're probably like 12 months already into the narrative change. So yeah, so conviction driven, some people have it. I don't think it's very lasting, because every single crypto cycle has been different from the prior one. So we follow our curiosity. We focus on the fundamentals that you'd expect. We are essentially serious people, builders. I'm actually right now, if you think about it, I think I'm the only GP at a crypto fund that has been a crypto founder. There's nobody else. It's such a common archetype in traditional venture, but there's not that many crypto companies. And definitely not successful ones. And there's not that many of these folks usually in crypto. People are just consummate investors. They come from the investment. So they lack the empathy. They lack all of these other things. And they lack the feeling of knowing what it is to build a business in crypto, especially a business where, once every 3 years, 80% of your revenue goes away, but your team is still there. How do you deal with these things? How do you deal with like the diversification of the revenue lines? How do you deal with the culture? How do you hire people that don't leave when the markets are down? So there's all these aspects. There's just, you have to go through it to feel it. And so I feel like that's actually maybe jumping the gun a little bit. One of my competitive advantages is the fact that I've done it. I've been there, lots of empathy for it. So I think founders look for that. And a lot of my portfolio today, a year and a half being a GP at Haun Ventures, is people that has come and self-selected into, I want a founder on my cap table, and I want a founder on my board. And this is something that I want right now. Explicitly so. They've come out with that explicitly, and many of them have had bad experiences in the past and don't want people that don't understand how the sausage is made and how hard it is to make the sausage. So no thesis. We invest on what makes sense depending on the cycle, and we do liquids and we do equity. And so we're also not focused on one versus the other. And so we always have the optionality of like going liquid, going equity. And as you've seen, up until like 7 months ago, equity was worth zero in crypto. And this year alone, we've had 4 over $1 billion acquisitions. So M&A is back in crypto, and there's a lot of money to be made in equity. Circle IPO, bullish IPO. Clearly, equity also drives a lot of value in crypto, which for a long time, I think the majority of people discounted equity as actually a way to make money. And we had never been here or there. We've always been like somewhere in the middle, like we'll do both. It's whatever makes sense for the business. And when people got excited that tokens was all the rage and tokens was the only way, we always knew that was not going to be the case. And if ever there's a cycle in which people think that equity is all the rage, we're also not going to be like fully there. There's definitely places where tokens are. I think that accrues value and makes sense.
So Haun has the early stage, the 500 million early stage seed funds, or we can call it that, and then the $1 billion acceleration, which is kind of growth, essentially. Where do you spend more of your time, or is it on both sides?
It's on both sides, and it's fantastic because you can do the crossover. One of the advantages of being one of the few funds in crypto that has an acceleration fund is that we can generally say that we support companies through the life cycle, from a $3 million check to a $100 million check. There's not many crypto funds that can actually do that. And so you can like transition from one vehicle to the other, and you can actually bet on your winners of the early stage fund with the acceleration fund, which is extremely unique. It really depends. I think I would say like from a culture, I like spending more time on the earlier stage. I think founders do, like seeing cool products, cool new ideas, pie in the sky. Growth, I wouldn't say is mechanical, but it's more like numbers driven, and you have to be on top. And we're very aggressive, with secondaries and opportunities to get in at good prices and things like that. So, net, I think they're both maybe 50% of the work. Growth is a lot more work, because on a seed stage, there's only so much due diligence you can do. But growth is a lot more work, but less number of deals and higher check sizes. And then seed, obviously smaller check sizes, more deals, and just, more pie in the sky, fun, but less due diligence overall when compared to a growth stage company, which are going in sometimes at multi-billion dollar valuations already.
What percent of your investments, the ones that you're driving for, are kind of liquid tokens versus equity, or is it kind of a lot of deals have both? So how do you?
So right now, the large majority of them are actually equity with token warrants, and we're just giving the flexibility for the founders to decide what they're going to do, because it's not clear when you're starting a company. It's pie in the sky. 33% of companies pivot, and so you don't know what you're going to do, and you don't know who you're going to be. And so we want the flexibility to accrue value on both. And I do think specialists and being crypto specialists matters deeply in this space. I think the generalists hate the token portion still. And I think if you're a generalist, you're never going to be super successful outside of, constrained areas right now, which are very popular, which like stable coins. I think it's a fintech underwriting, so you can probably like be successful without lots of understanding like the substrate and crypto and how these things connect. But in token lands, in the rest of crypto, I doubt that you can be successful as a generalist without truly taking token positions and understanding when one makes sense versus the other.
Yeah. Okay. So speaking of tokens, what do you think is the ideal role for a token within? And also this is like it depends kind of answer, because like it depends on what they're building. But I don't know, in a perfect world, what is the ideal use of a token within crypto?
The ideal use of the token is to overcome the cold start problem. You have something that makes sense on its own. You have some loop that makes sense on its own that accrues value both for suppliers and consumers of whatever marketplace or product that you have. You have something that works. And then you throw in crypto economy to bootstrap this cold start problem, because you have to get people initially there and motivated to join the system in the first place. That's extremely hard. But when you do, that has to make sense on its own. Because a lot of the downfall of 90+% of these tokens are the fact that the core economic loop doesn't work. People don't want to pay for it. They're there because they're being incentivized. And the crypto tokens are actually hiding away the product market fit. So one of the things that is very hard in crypto as a venture investor to do is to judge product market fit when tokens are distorting the whole thing. It looks like it's product market fit, it looks like growth, but in fact is being subsidized. And there's nothing wrong with subsidizing something like, I don't know, PayPal was subsidized, or giving people historically $20 to kind of come into the platform. But it's because they have either an idea of how they're going to make money and how this is going to be profitable and, unit economics are going to work, or it's already working and they know, and they're just pouring fuel in the fire, which is the best version of it. In crypto, we sort of like put the cart in front of the horses, and it's just like, no, let's do incentives. And then we sort of forget that you needed an engine and you needed the horses. It turns out you need the horses to actually pull this thing forward and for it to continue. So that's why you see so many of these graphs, like of these like camel-shaped graphs, so like up and to the right, and then like down and to the right completely, all the way to basically zero. Is because people weren't concerned with the core process in product and economic loop, and they just poured incentives too early.
Yeah. So what role does the token play, or what should it play in a more mature, I don't want to say mature, but more mature business or protocol within crypto? Like, should they be quasi equity?
I don't know. There's, again, we're generalizing, but tokens as governance mechanisms to decentralize governance make a lot of sense. And there's not a lot of other options for you to do it. So when you have something that truly has to be decentralized, which again, I think we abuse decentralization. I think if anything, Hyperliquid has shown us that people that want to trade and want to have leverage couldn't care less about decentralization. They want something that works, that is fast, and so they don't care about decentralization. So clearly, we've been hitting this decentralization hammer on too many things and applying it to too many things. And all you have is a hammer. Everything looks like a nail, and clearly that's not true. And so the decentralization aspect does matter for many of these things. I think we can also talk about like the privacy aspects and a bunch of the actual security aspects that also are hard to inspect from the outside, and people believe that the consumers care about it, but they care about it in different ways, or only care about it when stuff goes wrong. Anyway, there's a lot of that. But the right answer is, if you have the need for decentralization and it actually makes sense in your case, then you need a token for governance. But now, is the token for governance the same token that is going to accrue value? And how is a token for governance accrue value? And is it which economic model? Is it a staking model, which you're locking supply, or is it another model where you have to kind of like burn these things? And there's actually value at risk. There's lots of economic models that I think would work if the core premise is correct, that you need decentralization and you need a token for it. And that is a necessity. In the large majority of the cases, that's not the case at all. And people are trying to do some pseudo equity for value accrual in just something that is liquid and is traded, and that aspires, that looks like an equity that may go up in value and whose sole purpose is to be traded. That's the majority of these things, is the thing that sole purpose is to be traded, in that has no value. That is just like a thing that is traded. It has no value. And there's some storyline about how this accrues value long term, but the product itself doesn't have utility. And if the product doesn't have utility, then this thing consequentially also doesn't have utility, because it's downstream from some utility that is being provided. Hyperliquid has utility. It does. People like it. People want to use it. People want to trade on it. Something like Lighter, which is another perps DEX, also has utility. People want to use it. And then if they have a token, then it makes sense that if they're buying back the token, that the token would have some value. And if they have need for this to be decentralized, then maybe there would make sense for this to actually have a governance token. But you can't put the horses in front of the cart, or the cart in front of the horses in this particular case, and just say, no, I'm going to do the incentives, I'm going to do the governance, I'm going to do the decentralization, but I'm not going to care about the product and the value that it provides.
Is there an argument to be made for a company that launches a token or some sort of protocol, and it's useful, people are loving it, they're generating revenue, and they decide, hey, we don't really want to IPO, we don't really want to sell equity, we prefer to design a mechanism where this token that we've launched accrues value? Is there a place for that? Or you think that, no, I mean, if you're kind of, talk like a duck, quack like a duck, like you're a company, you should just go the equity route?
No. I think there is a place. And I think finally we're getting to the place where that makes sense, which is an on-chain IPO. And there's actually a portfolio company like Superstate and Robert Leshner that is doing this with Opening Bell, which is, at some points, right now, you need $500 million run rate or recurring revenue to go public. And the bar is too high. We should lower the bar, not for transparency and quality of companies, but just for revenue. So we should make an easier path for people to go public. And why can't that be a token that is a security token? It is a security token. We're not trying to pretend this is something else. It is a security token. It provides those advantages. It's just that on-chain security token. It gets listed and issued on-chain only. It may be uplisted in the NASDAQ at some point in the future, but initially gets listed in trades on-chain. And it is a security token, and it is a mechanism by which the company can issue more tokens and fundraise. I think that's perfectly fine. And that's very clear. It is a way to fundraise, like public markets are a way to fundraise, being listed, but it is a security token. We're not trying to say that it's a utility token and then trying to fundraise a utility token. And there's another aspect, which is there is something to be said about fundraising for a project in the ICO boom. There was something in terms of capital accumulation and bootstrap that made sense with the ICO that really hit a nerve, right? In this particular case, it was way exaggerated and there were people ended up losing money. But as a mechanism of company formation and capital formation and gathering, there's something unique here because we've put the bar too high with the qualified purchaser and the qualified investor. And clearly that hasn't aged extremely well. The intent was good. I think it still had net benefits in general, but it's getting too long in the tooth, and we should have a capital formation way that is lower bar. The say that we see for some of these, hardware products that are being put on these websites, like Kickstarter. That's a new way to do capital formation, right? It's pretty cool. And so stuff like that, but for companies or for projects, I think there's something new there that needs to exist. And whether there's a security token or how that's done, we can talk about it. But generally, in that sense, it is a fundraising mechanism. And the expectation is that you're going to make value and it's an investment and you're going to accrue value for being an early stage backer of this thing. And you're not going to get the product in the case of Kickstarter, you're going to get more economic value or in the future from future revenues. So there is a space for it, absolutely, for fundraising. There's a space for it for absolutely on-chain IPO and issuance. It's just we've been conflating all of it. And we've been saying governance tokens are for governance, but then we sort of wink, wink, nudge, nudge, expect it to be capital formation and to accrue value and on and on and on.
In the future, do you expect security tokens to all have the same or same-ish value accrual mechanism for that token economy? Will they all be buy and burns or whatever, or will it differ?
No, I think it will differ. Look, there's not that many mechanisms. It's supply and demand at the end of the day, and there's only so many mechanisms of you taking the supply away. One is burning them, one is holding it back yourself, the other one is forcing people to hold it back by locking it, and the other one is giving people incentives for them not to spend it. That there's all these things. There's only so much innovation that you can do here in terms of the general, but how it fits into the product and how it makes sense for your product and your ecosystem, that totally is I want innovation. I want founders to tell me how that's done, right? It's not the opposite. It's not going to be this VC is going to tell you how token economics should work. It has to make sense for your product. And I think one of the things that we have suffered is this one size fits all. We're just going to do whatever people have done, and it makes no sense for my product, and I can't justify it, but it's what everybody else has done. It sort of worked at least once or twice, so I'm going to just repeat the playbook. That playbook repetition, I think, is the thing that is kind of dying off with a lot of these pre-TG rounds and with a lot of the over abundance of tokens out in the market, and part of the reason why I think we're not in alt season and why a lot of these haven't really come back up.
When you're sourcing deals, what are the primary sources of, or kind of primary funnels? Because obviously you guys get tons of inbound, but have you noticed that the inbound is at maybe a lower quality on average comparative to outbound, or kind of what are your primary sourcing funnels?
So people that I've known before or worked with me before, either starting the companies, which is the best, or referring personally companies. So extremely warm intros of this is the best person I worked with and they're starting a company and I want them to work with you. Then there's people that I haven't known before but know of me, and they say, hey, there's only so many people that have started federal chartered banks in the past and that are working crypto and are VCs. You may be the only one. And so I really want to start a new bank and I want to work with you. So that's perfect VC founder market, VC founder fit, I guess, if that exists. Which is there's a very reason as to why I'm getting this deal, which is something that you have as a venture capitalist, which I'm not. I'm an engineer that allocates capital. But as a general venture capitalist, you have to understand whether you're getting adverse selected against or not. And you have to have a good answer as to why this deal is yours to win or why it's coming to you. And that's a really good answer. It's no, I'm the only person for this one because I'm the only person that has done this. And then finally, I think just people that are not fitting category 1 or 2, but they have enough hustle to find a really good warm intro from somebody that trusts them, that's already pre-validated. And then I do have, my website has a place where you can answer some quick like puzzle venture capital questions that are extremely simple, and then you can drag and drop and send a pitch. And I look at every single one of them. It's just the majority of them are low quality. And so if you are doing cold outreach and you haven't gone to the work of actually just getting a warm intro to me, which is extremely easy, I have to say, or at least it feels to me that's extremely easy. Like I know so many people, there's so many ways for you to go in and create relationships, or even some proof of work of like, it's not a generic pitch, it's like super tailored. Even with AI now, you don't have an excuse for this not to be extremely tailored. And so it's just extremely lazy. And if it's extremely lazy, I will read it, but I will do heavy discounted on whether I think it's interesting or not.
And do you also form your own theses internally at the firm where you say, hey, we see this trend happening and we think that these startups are needed. Therefore, everyone, let's go start looking for these?
Yes, 100%. It's not the main way in which we operate, but it happens all the time. Or a little bit like this, Excel historical, like a prepared mind. Like this makes sense. Let's look at all the markets. Let's look at the market. Let's look at the players. We believe that there's white space in this particular area. So let's just keep a prepared mind on something that happens here. I want to see it. For me, one of them is generative finance. If you think about LLMs, and they have proven that you can turn language into code. And if you look at DeFi, we have proven that we can take code and turn it into financial instruments. So if you connect one and the other, we now can turn language into financial instruments. I think this is what I call generative finance, which is finance is about to be changed from I have a product that I want to sell to millions of consumers to I'm going to sell millions of products to millions of consumers because I can tailor the product to the consumer. And if you're creating a company, you now get to create infinite number of variations of financial products because they can be tailored to the consumer, or it could be the exact product that you want without you have to going to Goldman Sachs and do like a multi-year partnership that has to have a minimum of $1 billion of AUM for it to actually make sense. So generative finance is like new superpower that we have of using LLMs to go from language into financial instruments. But I think it's pretty cool. So I'm always on the lookout for people that fit this narrative. How are they fitting into it? I know it's going to happen. Is it vibe coding for financial products? Maybe. Imagine a vibe coding thing for financial instruments where you can just like, I want a type of like fixed income product that you click around that has this type of yield and this type of risk and, does automatic back testing of how it is behaved. Like that would be a really cool product. I'll love to see it. So if you're listening to this and you have a product like that allows me to vibe code a financial instrument, that would be awesome. I want to see it. And then, it helps you with the regs. This needs to be registered. This not needs to be registered. This can be issued at a token. This can be traded here. Be careful of this, be careful of that. That's so cool. That would be a great idea. And so that kind of thing is the thing that I have right now prepared mind for, and I'm looking for in putting it out in the world so I get it. Other things are more just general views on the market. For example, one of my own is I think fully homomorphic encryption and zero knowledge will accrue a lot more value outside of crypto than inside of crypto. That's another one. I think we're pouring billions of dollars into this research within crypto, but I think, making blockchains faster or, that's very low outcome and impact in the world at large. And what's going to have much, much higher applicability is when a bank can truly have encrypted or oblivious information and they can still query on it. And so whenever the next N+1 bank gets hacked, which invariably will happen, my SSN will be leaked for the 10,000th time. And my information, my new address won't be leaked for the 10,000th time because they don't have access to data, or they only have it at access to data in some particular situation, or they can actually run queries and like Apple does with some of their cryptographic mechanisms that allow them to actually have population level view of analytics without having individual level ability of knowing how many steps Diogo is actually walking. So stuff like that is, I think, extremely interesting. And I think it's coming from crypto to the outside of crypto. But we're not going to see probably a crypto company that is going to like use this technology for a mass effect in the $100 billion market cap. But we're definitely going to be seeing people use that technology to go out and sell to the corporates, databases, whatever it is, that technology to really have very large impacts in the world. So that's another like prepared mind or thesis, if you want to think about it that way, that I keep on the lookout for, that I really want to see happen.
Very cool. Okay, so let's say that you find a exciting generative finance company that's building something really, really cool. You're excited. What is the diligence process look like from kind of the you get a warm intro. It was great first call. What are the next steps?
So let's assume that they're at the earliest stage. They have an idea. I think first you have to understand founder market fit. why are they the right founder for this? Founders can create any company, but the founders that end up succeeding are the founders that have some reason to stick with this particular company and this particular idea. And sure, 30% of the companies pivot and founders can do many things, but in general, having the resilience, people sometimes call it grit, to actually stick with something means that you have something in your past and in your career and in your knowledge that really drives you in this direction. For me, sticking with Anchorage, I think Chris Dixon at the time when we led my Series A, Andreessen Horowitz said, I mean, this is perfect founder market fit. It's like two security nerds protecting private keys for large institutions. That's it. That's perfect founder market fit. Doesn't matter what happens in crypto. They love the tech. They love blockchains. They love private keys. They love security. They've been doing it for like the past, 12 plus years of their careers. They're going to continue doing it for the next 12 plus years. And he was absolutely right. And so that's sort of also why I emulate on my founders is like, why are you doing this? Did you just like fell into this? Did you just fall into this? Or do you have some other reason as to why you want to do this? The other one is, am I learning something from them? So do they very quickly, either if they weren't experts, got to a point where they have enough information in a field to which I have surface level knowledge. So it shouldn't be hard for you to educate me on some knowledge, some field, except if you go directly into one of my specialities, you should be teaching me something and you should be able to communicate complex ideas in a very simple way. And it turns out in crypto, it's people all the time try to talk about like gibberish and like super complicated stuff where they could just take a level of abstraction that was much simpler to communicate what you're trying to do. And then they go down to the details and they believe that, technology for technology's sake is something that's worked in the past for some blockchains and layer ones that have returned a lot of capital to investors, but I don't think is the reason why these blockchains are succeeding right now. So I think that world of like better technology just for better technology's sake is sort of gone. And it's really the primitive and the new use case in the new user set that actually is coming in, or the current user set that you can kind of like steal and siphon off to your application that matters the most versus the technology itself. So I think those two at the seed stage are the most important parts. And then the market, like, is this a big market or are you just working on something that is extremely niche? Are you working on, something that has like a client set of like, there's 10 people in the world are going to sell. And maybe it expands from that because you want them to like win a niche and expand, but the niche that they win has to have some adjacencies. It has to have some capability of expansion, and you have to sort of see some of it. If you're going to work on something that is like, I don't know, like agriculture focused, and it's like you're going to sell to people that are using drones for agriculture, maybe it's a great idea. I know nothing about it, but let's assume there's actually not that many, and there's like a few clients. I'm going to hesitate because, okay, you're going to work for drones of agriculture, you're going to go sell this for drones of some other kind. War drones or whatever it is, because there's a lot more recreational drones that are doing recordings than there are drones that are doing farming, right? So anyway, that's the general purpose of like understanding the market, adjacencies. Are you capturing a small market and then expanding, or are you just going after a market that is too small? And again, these things are levels, and this is the earliest stage when you basically have nothing built. And then from that moment on, you start evaluating the product, you start talking to clients, start evaluating some of the early hypotheses of revenue. Are you converting customers? Are you retaining them? You're going to talk to the customers. Are excited the customers are? Is your NPS like extremely high where people are just like the organic referrals that this thing is putting off are fantastic? And me as a product user, am I getting excited about it? Am I not getting excited about it? So then you kind of like all the way to like growth of like, does this really work? Net retention, all of these other aspects of like, do you have a profitable business? What is your margins? How's your margin expansion? What's your attach rate? All the way to like C, D, E in later stages is how you evaluate it.
What are some red flags that are like not very, because obviously, we can point out like the easy red flags, but what are some red flags that are more sneaky in some sense?
So there's a lot of red flags. And to a lot of this, you get enough reps to kind of get an instinct for red flags. And sometimes it's not red flags. Sometimes it's just not a founder that I want to work with. And I think that's fine. I think it's totally fine. Not everybody likes me, and I'm not going to like everyone. And I'm committing for 10, 12 plus years potentially of working with you. I want to work with people that, not people that look like me, but people that I can have reasonable arguments with and that can teach me things and have like a positive attitude on life and are really passionate about the thing that they're doing. So I'm looking for that. I'm looking for passion. And so anything that is the opposite of that, a curmudgeon, or somebody that is not able to explain to me something in an easy manner, or somebody who's not excited to be on this call, or somebody that thinks, I'm doing them a favor for being on this call versus, we're peers in different, lines of business, but the dynamic should be of peers and equality, not a dynamic of either the investor has more power than the founder or the founder has more power than the investor. So there's lots of stuff there. I mean, if you're an asshole, I'm sorry, I'm not going to fund your company. It may be very exciting, but life is too short to work with assholes, right? And so it's all those things are things. There's so many red flags that are just human red flags. And then you have the co-founder flags, the weird roles, the weird definition, the like not great relationship and rapport between the founders, shady history and kind of like execution in the past, complexity that is not resolved, lack of depth in the market, no clear explanation on how they've derived this idea. And it's kind of like, hey, I was in the shower one day and like this thing came off. And so I quit my job and started doing this. Is a very different story than I've been working at this company for 15 years. And I solved this problem at this company. And now I want to do the same thing, but I want to do it for everybody else. That's, I think a much better story than you coming out of nowhere for a space. So all those things are what I would say. There's very green flags, but there's also like corresponding red flags on the spectrum.
And how is the decision-making process structured internally in terms of, maybe you find a great deal, but, is a majority votes on it and like, okay, we're going to do this deal, or is it just you, or how does that?
So we essentially have a 1-to-4, we have a voting process and we have what you'd call a traditional IC process, but the IC is not to decide whether the deal goes forward. The IC is to really pressure test conviction and make sure that due diligence bar is met. And so the ideal is that your partners are pulling you in why a company can work when you're hesitating, and asking questions about like, how it cannot work when you're extremely bullish. And so to try to temper like your everybody has highs and lows. And so great partners are there to like make sure that your volatility is actually kept within a minimal range and you're making right decisions that are consistent and that we can point back to decisions and not of like, I was hungry that day and so I said no, or I was full that day so I said yes, whatever. So you're trying to eliminate that with power that's actually pressure testing. But really the process is if somebody has conviction and is pounding the table for an investment, then it carries. And there's a vote from 1-to-4. One is I absolutely will not do this deal. And 4 is I will do this deal if you don't do it. And you can carry even if it's like 1-4 from the sponsor in all ones. It's just that person is going to be extremely uncomfortable with like, okay, or has to be extremely comfortable with their due diligence. So like answering all the questions that came up and understands the other point of view. But no decision by consensus. I think that doesn't drive the best outcomes.
Does that make ICs lively? Because if everyone's kind of steel manning the other side, does that make it more debate and fun, or is it like how is it kind of?
No, it does. It absolutely does. But it's also there's a risk, right? Because it's very easy to sound smart by bringing up problems, and pessimists are right, and optimists make money. And I'm here to make money and make my money to my LPs. So ultimately, you want to be pending towards optimism, and you don't want to just steel man the argument just for steel manning. So it's really, I think the line of sight should be you're helping your partner have conviction and get to conviction. Conviction is extremely rare, and getting to conviction is extremely rare. So you're sort of like facilitating the process. And then, to a certain extent, like tempering again the volatility, and then reminding people that, look, we're going to do 3 deals this year on a per partner basis. Is this one of your 3 deals? You sound like you're hesitating here and there. Like from the outside, many times you can actually bring something that is obvious to you, but it's not obvious to the person that is like running through it. Sometimes they have investment fatigue. They've been looking at this investment for so long, they're just going to invest because they've already, sunk cost fallacy. They've already invested so much time into this that now they want to do it because they want to do something. Or sometimes they just feel like they haven't done a deal for a while, so they want to do something. And they're like, no, don't rush it. Like, we're here for you. This is not something they're like, this is a trust-based exercise. And so, yes, you didn't deploy anything into 6 months. Maybe you'll deploy 5 checks this year in the next 6 months. Maybe you'll deploy 0, and that's fine. And maybe you skipped like the top of the market. That's amazing. But there's a huge trust component here, and you're here to like help your partners get to conviction, but really also be an external voice that when they're too excited brings them down, when you're not excited enough brings you up, and just brings you out of your own like thought process and loops.
How do you think about exit? Because tokens introduce a very interesting mechanism for early liquidity sometimes, and so you kind of have to decide: are we gonna, what are we gonna do with the token? And then also there's secondaries, which you can do on the equity side. So how do you guys think about exit?
Yeah, my personal view here, and there's different opinions in the fund, but roughly I think this matches, is like, look, I'm a venture investor. That's what I want to do. And so I want to hold things for the long term. I'm not a hedge fund. I'm not trading. I'm not actively trading. So what I hope that crypto with tokens does, and it's a very different asset class because it has early liquidity. What I hope it does is it brings back venture from the 10 to 12 years that it is now, maybe back to the like 7 to 10 that was before. Maybe in some cases like 5 to 7 instead of 7 to 10. I think that's what I hope internally ends up happening, and which is we have faster liquidity than what's on the market today, but we sort of mimic what venture investment was before. Not we are now like getting DPI and getting out of positions back and forth and getting its deals and out of deals on a yearly basis or every 2 years. Now, we should have a 5-year holding period at least. And if you don't have conviction to hold this thing for 5 years, then we should probably not actually like be holding this thing and investing in it. So investments, not trades, if that makes sense.
Can you foresee, you said something interesting there where you would ideally like to kind of minimize the time to go that companies go public because it's gotten kind of too long now. Could you foresee a situation where companies are kind of quasi, essentially going public in crypto, let's say via Superstate, for example, and then they eventually will uplist to the traditional stock market in some future?
That needs to happen. Basically, I think the world, as I envision it, and as Robert envisions it, is exactly that. It's like first you go on chain IPO, the barrier and the cost is lower from a revenue perspective, but transparency is there. You need audited financials, you're reporting everything. And then by being on chain IPO for 2 to 3 years, you already have enough of a path and hopefully revenue growth to one-click uplist into something like NASDAQ. So it becomes a pipeline of uplisting on the NASDAQ as the ultimate goal. The public markets are amazing. They're liquid, they're well-built, they're functional, they have their issues, but they work by and large. Let's just create something that is a feeder school for the large IPOs in which you can see them in market, you can see the CEOs operating in a public, you can already have like more scrutiny and more transparency. I think that would be the ideal version of the world, yes.
Very, very cool. Okay, so where is Diogo in 10 years?
I hope doing the same. I might in the long distant future like start other companies, but I'm never going to be just doing one thing or the other. I always want this, have my hand on all the pies. I'm loving this, Andrew. I'm absolutely loving this, operator when I want to, as foundation chairman when I need to help, and kind of like as it's and then investing. All the pies, having hands on the pies and being able to like switch my hats, and they feed each other extremely well. Crypto companies and protocols come to Anchorage to be supported. And guess what? I have a checkbook. Or I have a checkbook and invest in a company. Guess what? Anchorage could be one of the companies that supports your token. And so there's a lot of like internal knowledge of how we support things and strategic positioning in the market, things that I see at Anchorage that are useful in my investment. And the opposite is also true. I see the whole market as an investor, which I really didn't see when I was just focusing on operator as the president of the company, right? And so those two things are just like feed off of each other extremely well. And being chairman of a foundation, foundations are very weird. They work in very different ways. And that gives me an appreciation on how to judge other foundations and how to judge protocols and how to advise people, because I've done it now. I've seen it, I've done it, I know how different it is. So if you are hoping for advice from your venture investors, then it helps that not only I've been chairman of a foundation, but I've also actually ran a company, a crypto company in your space that is doing things hopefully similar to what you're doing. So that's what I would say. And the future is more of the same, maybe in different percentages. Maybe at some point in a very different future, 20 years from now, I'm doing like even more operating. Or maybe I'm doing even less operating and I'm actually like deploying into larger rounds, smaller rounds, focusing on just seed. I just love it. I really follow my curiosity and passion. And I do think still that I'm going to be working in the space one way or another. I've never worked on anything else and I have no desire to work on anything else.
It's amazing. Okay. So it does feel like a very uniquely American view that people should quote unquote do one thing. Like when you go anywhere else, like in the world, essentially, you talk to someone who's an entrepreneur and they're doing like, oh, I have this oil and gas thing and then I have this thing and it's just like, it's totally normal. But in America specifically, what I found is that like, it's people think that, oh, you're too distracted. But in reality, what you're talking about is it's extremely symbiotic and they actually add value to each other. Do you think that I don't know, do you agree with that statement? And second, do you think that being multifaceted, will that evolve to be less of a thing in America, be more of a thing in America?
Yeah, it's kind of hard because we have such a good example of the opposite of what I'm about to say. But I would say for the large majority of people, this benefits them in seeing different things and having hands on different pies. It benefits them. It's way more fun. You get less into like deep rabbit holes, not as much anxiety about one thing. On the other end, I think it's like being a professional athlete. You're only good at a professional athlete if you do one thing. There's nobody that is good at swimming 100 meters and doing the 100-meter dash. That doesn't exist. It's never existed. It's never going to exist. It's just like the body shape is different, right? And so in that sense, if you want to be truly, truly world-class and the best at what you do, I do think focus is absolutely required. But you can be, top 10%, top 5%. You're just not going to be the best in the world, single individual best in the world at it. This said, you have Elon that, is done so many different things and has been able to actually be the single best at like electric cars and, spaceships and maybe boring tunnels, who knows? Maybe AI, Grok is getting up there in terms of like competition. So, that's obvious counterexample. But again, like if you're looking for Elon as inspiration, let me tell you, you're not Elon.
Yeah. Yeah, very, very true. All right. So okay. So speaking of Tesla, and Elon, but Tesla specifically, you said previously in our conversation that you believe AI could make companies smaller and very hyper focused on certain subsectors and whatnot. But then I don't know. I look at Tesla and other vertically integrated tech companies or just companies in general, and that seems to be a trend that we're headed towards, is more vertical integration, controlling the full stack. How do you see AI kind of going against that trend? Maybe that trend's not correct.
Yeah. So both can be true, right? We can have a median of companies that are smaller, and we can have, for example, an average that actually like increases. So you don't need to have both. I think generally companies have more fat than they need to in a world of AI. Like the companies that have 100 people, 200 people, 400 people, I think they could be meaningfully smaller, like half the size or a third of the size. So the large majority of the companies will reduce in size. Some companies will find such good ways of either like coordinating companies within companies, which is sort of like what Elon seems to do. They have like, think about Grok and X, like these are totally different products that sort of like have a connectivity point, and now they're running within the same umbrella. So maybe that's one thing that happens, is like coordination within one umbrella is still better. But I think in general, coordination is becoming so much easier, that if coordination is easier and the cost of coordination outside of your company is lower, then the expectation is you need less people. Because one of the reasons why companies grow is because it's cheaper to hire and do it internally and have no like outside coordination effort than to interact with an external company. So I think definitionally you will have more specialized, larger numbers of companies with smaller set of people, while there'll still be like a bunch of behemoths that will find some way to be extremely good and take some advantages of scale or whatever by being like these behemoths that are very large. I think both things can happen. If I had to guess, I would guess that in general, I think both actually like come down. That a Google or an Apple, we will not see many companies with like 50,000 plus employees. That will not exist. Unless you, I guess, have a retail presence or something like that, where you need actually like still people on the ground. But of engineering and things, there's just like not that many things that a company can do and be world class at. And maybe there's a couple of outliers, but by and large, the median is going to be smaller in terms of number of people.
So with AI, humanoids, et cetera, all this new technology that's coming out, crypto as well, do you expect there to be an explosion or kind of are we in like the early stages of a massive amount of company formation over the next 10, 20, 30 years? Or is this going to be the opposite impact, where there's actually going to be aggregation? There's going to be less companies going forward.
I think more, and we're seeing it post-COVID actually, massive rise in company formation and LLCs being formed. That's the graph is actually pretty impressive. We can pull it up. I think there's going to be more. It's so much easier for now. I mean, as a venture investor, it's worse for you, but it's so much easier for anybody to just code themselves an app and try it out in the market, and then have a one person. Everybody's saying about the $1 billion company. We haven't seen it yet, right? And so that's the trend line, and I do think that will happen. If that's going to happen at the cost of like the general companies like reducing in terms of size, I think so, because there's going to be so many more companies that are like high revenue and low body count, that it's going to bring the median and the average down, maybe without touching the big ones that are working already. But that's going to happen, and I'm seeing it. I'm seeing it with my friends. I'm seeing it with my peer group. I'm seeing with other CEOs that I talk to that are just like definitely like wanting to have. They're jealous of Hyperliquid and Tether in terms of like revenue per body count.
It's insane. I mean, the numbers are absolutely astronomical, and the head count. I think Hyperliquid has like 12 people or something absurd. So who ends up winning? And this is like a very broad question, but AI, like who ends up winning? People are saying it's going to be the wrappers. Some people say it's the infrastructure providers. Some people say it's the model providers. Like who ends up? Where's value accrue?
Society will win. There's so much value has been created. I don't know, if I had to do a spread trade right now, I probably would buy the equal weighted S&P versus the actual traditional S&P, because the traditional S&P obviously is highly weighted towards the Mag 7. And I think that the economy at some point the value from the Mag 7 has to come down to the economy, the general economy, and uplift everyone. So I think that that's actually going to be true. I don't know who ends up winning. Clearly, the infrastructure providers are always going to win, and they're the ones like the folks selling electricity are going to win. The folks selling hardware are going to win. The folks selling data centers are going to win. The folks with value-added services and clouds on top of these data centers are going to win. Those are definitely going to win. But also, like, more companies are going to be started. The market caps for these things are going to be higher. The amount of seed capital you need to bootstrap an idea is going to be reduced on the large majority of ideas, and for some is going to be even higher for the actual models themselves. Clearly, like, this thing is going in two directions at the same time. That's why you can't answer one way or the other, because if you're a model company or an AI company, you need more and more money, and if you're not, you need less and less money, and these things are somewhat happening simultaneously, right? So I think overall society is winning the most. I would be very happy with like holding an index of the world's economy as we go into this AI. There's ways to optimize it, but I don't know if I would try to pick and choose.
Out of every answer I thought you could have said for that, I was not at all one that was on my list. So very, very cool answer. Very cool. All right, Diogo, this has been amazing. It is time for the closing questions.
Let's go.
All right. You have to tell portfolio companies that they can only build on this chain that you suggest for the next 3 years. So whether it be ETH, Solana, whatever, but they can only choose one chain for the next 3 years. Which chain would you choose?
I think right now it's still probably Solana. I still think it has the largest momentum and the largest upside.
Love it. Okay. About the future of crypto, what makes you optimistic?
What makes me pessimistic is I don't think we've pushed back enough against early liquidity for founders of some of DeFi projects. I've said publicly that DeFi will never be successful until DeFi founders have 7-year cliffs and 10-year vesting. And it's very easy to have early liquidity and become extremely rich and lose conviction and not have to work hard for it. And I think this happened over and over again and continues to happen. So that makes me bearish, because the people around the table still feels like the average quality in terms of seriousness of the founder is still not as high as other places. The thing that makes me extremely bullish is that with stablecoins, I see extremely great fintech founders that have never been into crypto. They're now building on crypto rails, completely convicted, and building extremely exciting companies and increasing the pie of humanity and actually building like credible companies with revenue that, is what I've done. Anchorage does not have a token. Anchorage is federally regulated bank that has equity. And so to a large extent, I've been on the camp of TradFi more than on DeFi, even though I love both. And I think that makes me extremely bullish on the talent influx that is coming on this particular narrow vertical. And I think it'll benefit everything else, because naturally these founders are finding themselves very interested about the sources of yield coming from DeFi. And so they're expanding their view and they're coming into crypto through fintech. So fintech is a gateway drug into DeFi. And that means that the quality of founder is about to increase quite significantly.
Amazing. All right. Looking back at your time in this space, what's the biggest thing that you've changed your mind about?
How the United States regulatory regime works in general. I've been very disillusioned on how, the political class can actually influence things that should not be influenceable. That has been a little bit disappointing in terms of how the system actually works from the inside. So that's been something that is just, I think right now, the things that are happening are generally good for crypto. But the way things happen to me matter. And I think the way things happen is kind of disappointing. And it was a learning over the past 8 years of Anchorage about things actually working reality versus my expectation.
So really quick, I want to dive a little bit into that, because I was having a conversation recently with a friend on, I also, because for the first time ever, crypto is like not, where like it's normal, it's not like criminalized essentially. And I was like, oh, all we had to do was just donate lots of money to all these politicians, and then that was it. Like we just donated a ton of money, and we were arguing over that and how it's my friend was saying it's kind of like legalized corruption. And I was like, yeah, in some sense, yes. But also the alternative is, we have actual corruption. And in some sense, this lobbying style system is better than actual corruption.
That's it. There's no alternative. Or, in some European countries, they don't have lobbying, so they don't have legalized corruption, and they're very hard on actual corruption, and systems still work. So I don't want us to kind of like have the conclusion here that it's just absolutely not possible to have a system that works extremely well and doesn't have this kind of thing. But I will confess that obviously, like, we have seen that in many cases, what ends up happening, and it's outliers in places that work extremely well with no corruption, but also no pay to play. And the system that we have very much clearly, as described, is pay to play. And that just like leaves a bad aftertaste.
Totally. All right. How is this entrepreneurial journey that you've had changed you as a person?
You wake up and you get punched in the face. And I think the hard things are the things that are the most rewarding. It's the answer. It's like being a parent. It's happened to me. I have 2 kids now. Third one is on the way. And the hard parts are the things that make it extremely rewarding. the challenges are the things that I remember. That even all the way to Square, the times I remember the most is when Nathan and I were in the trenches. I took Square offline for 2 hours. I made us lose tens of millions of dollars because of a configuration bug in one of the firewalls. I remember that very vividly at 2 a.m. And the good stuff, I remember a lot less. So those are the things that form your character and that gives like meaning, are the hardest ones. And being an entrepreneur is extremely hard. And being an entrepreneur in crypto is like extremely hard multiplied by 10. Not just because for the past at least 4 years of the power administration, I felt like I was a criminal. I was an American citizen that created a federal bank that was trying to help companies coming to crypto, and somehow I was being treated by regulators as if I was a criminal. That was, very challenging. And also the volatility. It's like you're building a business that is very exposed to crypto volatility, and that's also extremely hard for a founder, right? It's founder in hard mode. 80% of your revenue disappears every 2 years. Now it's no longer the case, and you've diversified the business away, and it makes you more resilient. But that's also like, it's very hard. And then it becomes even more meaningful at the end when things end up going well.
That's amazing. All right, last question. This one's for me. When can I buy some Anchorage shares on my, go into my Fidelity and buy some Anchorage? Are you guys planning to IPO or what's going on?
The answer is hopefully soon. I think every single founder in the space is looking at the current environment, bullish IPO, Circle IPO, Figma IPO, even though totally different space, and the Trump administration as a favorable administration under which to kind of like do this. So all of us are thinking about it. I talked to all these other peers thinking about it. Whether it happens or not, we'll see, but hopefully soon.
Amazing. All right, Diogo, where can people learn more about yourself and Haun Ventures?
So diogomonica.com or Diogo Monica on Twitter, and then Haun is haun.co. Feel free to shoot us an email or a pitch through a warm intro if you're interested in having us on the cap table.
Amazing. Thank you, sir.
Thank you, Andrew.